Hi everyone, welcome back. Negative yields, inverted yield curve, asset bubbles, and more. Oh my! There was always a lot of sensational headlines in the media to get us to click on an article. The reality is growth is slowing down, but there is no forecast for a recession similar to 2008. Today, I'm going to highlight a few stocks to buy for a slower growth economy. They'll pay you a healthy income while we wait for the latest rounds of lower rates and fiscal stimulus. Come on, Fed, you can do it. Cut that rate one more time. Good, Fed. Infrastructure companies can do well in a low growth environment for a couple of reasons. First, lower yields allow infrastructure companies to borrow at cheaper rates, contributing to their bottom line. In addition, governments can spend more money on infrastructure projects to create jobs to boost the economy as savers stop spending when their fixed income investment yields are low. Tax cuts can boost infrastructure projects and provide a lift to companies. So what can we buy that hasn't already jumped in preparation for the next phase of the market? Hi, I'm your government. Do you want some money for some bridges? You want some money for some water infrastructure? You want some money for some low-cost housing? You want some money for some highways? The Invesco S&P High Income Infrastructure ETF is a low-cost, diversified basket of 50 global infrastructure-related investments. It is rebalanced semi-annually. The current return on equity of this investment is a healthy 25.64%, and the current distribution rate is 5.1%. The investment is allocated 49.6% to utilities, 38.21% to energy, and 12.19% to industrials, with investments in Australia, Norway, China, Spain, France, and the United States, to name a few. The top holding right now is Inter Pipeline in Canada, and this has a rumored takeover of $30 per share, and we'll have to wait till after the federal election. The shares are currently trading closer to $25 per share. Top holdings include Ship Finance, Sydney Airport, and SEM Group. Smaller holdings include Hutchinson Port Holdings Trust, one of the largest port providers in the world. This has a low MER of 0.45% and is diversified and producing cash flow. The symbol is GHII. I'm also going to revisit my holding in Crown Castle, as the shares have ticked down over the last week as money has moved back into value stocks and financials. This is a result of the yield curve and trade talks settling down. Crown Castle is a REIT and somewhat infrastructure investment that owns over 40,000 cell phone towers in the United States with multiple tenants including Sprint, Verizon, and AT&T. What I like is the 75,000 miles of fiber they own that they are connecting to small cell nodes or radio transmitters for the build out of 5G. We know that 5G is going to be a game changer as Internet of Things, or IoT, connects billions of devices in my lifetime. 5G has a smaller radius to take advantage of hardwired small cell nodes. Crown Castle pays a nice dividend and is domestic based in the United States, limiting impact from a trade war. My last pick for a slower economy with lower yields is Granite REIT. We can buy gold as a store of value or hold cash, but I am focused on passive income over the longer term, and Granite ticks a lot of my boxes as an investment. Granite has a low beta of 0.56% and pays a cash yield of 4.45%. When I dig a little further, I can see Granite has funds from operations growth of 10% and a solid balance sheet with net debt to assets that is less than 30%. Granite has reduced their exposure to Magna to less than 48% of their revenues, with a focus on higher margin warehouse distribution centers. Granite has increased their distribution every year since 2013, and we could see them revisit a strategic review to add to shareholder gains with a current cap rate of around 6.4%. Double-digit growth, high-quality industrial properties, and a good balance sheet. These are a few of my ideas to create cash flow in a slower growth economy. As I mentioned, I did not include gold in my discussion as I'm trying to focus on long-term passive income investments, although gold can act as a good hedge and store of wealth in difficult economic times. I really appreciate my subscribers, and any comments or questions you have a prosperous day, everyone.